Well, look, Nelson himself tells his story in the first part of the book, and he does a great job. The bottom line, though, he was a very successful real estate investor. He was at the time accustomed to paying 9 and 9.5% interest, using other people's money for his real estate deals. But in 1980, real estate, was very profitable. But also in 1980, interest rates went to 23%, actually 21.5% prime. He wasn't prime. I'm not prime. You're probably not prime either. So we have to pay 1.5 points over 23% interest. And there he was caught owing $500,000 at 23% interest. $500,000 doesn't sound like a lot of money today to some people. But in today's dollars, that's the equivalent of $1.5 million. Mm-hmm. Right? $1.5 million paying 23%. That's about $115,000 a year in interest alone that he was paying at that time. Right? Today's dollars, that's about $375,000 in interest alone.
Yeah. There's a lot of big numbers there for some people. And at the bottom, at the end of the story, at the bottom line, this is a man who understands capital. Right? He understands cash flow and was right in the thick of it in a time when, throughout the history of the country, when interest rates were at some of the highest they've ever been, and quickly was acquainted with his own need for financing, for cash. And
I don't want to throw big numbers out. I'm just relating the numbers. Mm-hmm. He owed $500,000 at 23% interest. That'll get your attention.
Absolutely.
Well, and I'm just, and literally, you can move decimal points either way, mm-hmm. right? $375,000 equivalent in today's dollars of interest. So he was paying $115,000 in interest alone. It's a big number, and I want you to hear the effect of that. But look, at the time, his brother was a life insurance agent. He'd been accustomed to paying high premium in life insurance. He was paying at the time $18,000 a year in life insurance premiums. Mm-hmm. Who do you know today that pays $18,000 a year in premium?
Not enough.
Right. Well, in today's dollars, that's about $54,000 a year in life insurance premium. Okay. So, I don't personally think that he was trying to, indirectly support his brother. He's seen the value in life insurance. Okay. But there he was owing $500,000 in outstanding loans, interest rates, 23% interest. And he's seen that he had access to capital on a guaranteed contractual basis at 5% and 8%. Mm-hmm. So then he clearly realized he should have been paying $115,000 in life insurance premium and no more than $18,000 in interest.
Yeah. Had he been paying those higher premiums, he would have had enough access to cash to pay off his creditors.
He might not have ever even gotten into that situation
in the first place,
because he would have been able to maintain control.
I also think it's important to point out that what caused the creator of the infinite banking concept to come to the idea was hardship. And I know I've heard you say before, there's never a problem until there's a problem. And that's fully true. You could be going along depending upon third-party capital, and there's never a problem until there's a problem, until the need for cash makes itself apparent, as it did for Nelson.
Right. And that'll happen just dang near every time you're not in control. Mm-hmm. The banker will need more interest.
Yeah.
Right. The bank regulators will need more capital or more collateral.
If you found this video helpful, please leave a like. And if you want to see more videos like this, you can subscribe to the channel. If you want to learn more about infinite banking, you can watch this video next, or visit our website at bankingwithlife.com. Thanks for watching. We'll see you guys in the next one.